And my fixation for this year for sure is credit. Credit is incredibly interesting to me for this year, partially because we're walking into this year and it's already tightened a lot, but at very, very tight levels in both investment grade and high yield. So you have the backdrop of a year with not fantastic returns in practically any asset class, along with this belief that growth is slowing with the potential for negative growth at some point this year. And yet credit's walking in saying nothing to see here. We're tighter than our kind of like 50th percentile. Like this is actually going to be a better year than other years in credit.
Welcome to What the Finance. I'm What the Finance founder, Anthony Fatsis. So despite large portions of the community having been bearish throughout the past few months, and I'm not sure about yourself, Zed, but risk assets are currently booming. This has been further amplified by the recent slowdowns in inflation and the belief that the most aggressive tightening is behind us, potentially. So I'm very excited to welcome Zed Francis onto the podcast today, who's the CIO and co-founder of Convexitas. So Zed, it is wonderful to see you. Thanks for joining.
Thanks for having me.
Yeah, I guess what's your thoughts on the current actions? Because it's been pretty crazy.
No, I mean, your setup is perfect because it's been, I think a reasonably well-known fact that sentiment has not been very good, along with actual positioning has been maybe a little bit light. And that's been the case for probably 10, 11 months. Like that's not exactly a new story by any means. But today is actually kind of interesting. So January, obviously significant rally. US did really well, externally, outside the US as well. So assets prices going up a decent amount. If people in theory had, negative sentiment and light exposure, you would have thought, okay, that's not great, but you have that fun thing called the calendar. And amazingly, even though you might have been wrong side or an active manager might have been wrong side, it's only January. You got 11 months to go ahead and figure it out. You're probably happily sticking to your guns, even though it hasn't played out how you'd hope the first month of the year. But I think yesterday just kind of maybe caused a little bit of nerves. You had obviously a significant rally on the back of the FOMC meeting. I don't think he necessarily said anything, in my opinion, that was overly interesting or unexpected. But there was probably enough in there to cause a little bit of shaky hands. And this morning, we opened up nicely in the US hours and kind of nothing of note, to be frank, but mid-morning, all of a sudden we started really rallying. I mean, we kind of went from up, 75 basis points to 1% in the S&P, kind of 2x that, and the NASDAQ. A pretty significant scream from kind of mid-morning to early afternoon. And why this whole diatribe is interesting to me is volatility during that second phase of today's rally started expanding dramatically, like a pretty serious increase in implied volatility. And some of that was in, single names that were moving a bunch, but it was filtering into index. Like S&P volatility started increasing quite dramatically on a rally. And it wasn't a astronomical rally. I mean, almost 2%. Sure, it's a good move, but it's nothing totally outsized. But what it says to me is you finally got to a phase today where enough of those folks that might have been lightly positioned coming into the year in comparison with their normally baseline kind of positioning is said, shoot, I'm not allowed to hold this stance anymore. I have to do something. I have to adjust the book to get it a little bit closer to my benchmark, a little bit closer to market neutral, whatever that is for that manager. And often the first tool that those folks use is they obviously have fundamental beliefs in all their core positioning. So they don't love unwinding the things that they believe in for holding on to for 1, 2, 3 years. But they might go wander into the options market and start buying some things. And in this case, I think it's calls to go ahead and protect themselves from that underweight positioning during the rally. So you didn't see that. You really didn't see that, stocks up, vol up that much at all, like anything of note, all of January. But mid-morning to live, it's been a pretty serious increase in implied volatility. I find that interesting. for the kind of first time in the 33 days of the new trading year.
Yeah, it's interesting. So I guess, as you said, a lot of managers have probably thought, underweight, and they're thinking the market's going to go down further. But now it's like you can only hold on to cash for so long. You have to at one point, either put it in or potentially hedge what you currently have.
That's right, and it's easier for a first decision, if you will, rather than taking some cash and buying equities after the rally, to say, screw it, I'm just going to buy some calls. Like I still want to maintain this underweight stance, but I'm acknowledging things have moved too far too fast, that I'm looking too far off base of what I'm supposed to be looking like, or what people are going to compare me to. And so kind of like the first, crying uncle is often hedging whatever exposure you're trying to protect from, or movement you're trying to protect of, using options rather than giving up on your original stance. And I think you're probably seeing that today for the first time this year.
Yeah, and and I'm not sure if you're thinking this, do you sort of think it's potentially looking like a market bottom, or do you have any thoughts on that at all?
Yeah, I mean, it definitely is feeling a little squeezy. And the first, 3-4-ish weeks of the year, it wasn't necessarily the super high beta names that were leading the way higher. So I'd say that was probably more of a stable, longer term potential rally. But the last 2 weeks, it has definitely been some of your, negative free cash flow names definitely leading things higher. But that can go on for 6 months. I mean, look at 2021, it lasted almost a year. So exact timing, you never know with any of these things. But yes, I think today was the first kind of waving of the white flag, like, I'm going to have to do something. And the simple thing to do first for a lot of managers that have the flexibility to do it is just go and buy a bunch of S&P 500 calls, because that's probably the easiest way to get themselves realigned to kind of benchmark like quickly.
Yeah, definitely. So I guess, do you think they're doing this because of something that Powell said, or do you think it's maybe just because of the disinflation and people have started to realize, hang on, the hiking phase has finished, or do you think it's maybe just reacting to the current movements in the market?
Yeah, I mean, the current movements, or the what's kind of happened thus far year to date, is definitely the underpinning, right? And if markets year to date were flat, down, only up small, nothing Powell would have said, because I don't think anything was that dramatic, to be frank, I would have forced changing that positioning. But when you have the setup of U.S. side S&P up 7% before today, NASDAQ up significantly more than that, you're already feeling a little shaky on your positioning that you might have had on if you were underweight risk in comparison to where you normally are. And I think Powell didn't give any sort of green light or anything, but it might have been enough to say, that was kind of my potential catalyst to slow this rally down. And the opposite happened. And I look at the calendar, I'm like, what's the next catalyst to maybe cause any sort of reversion in this? Nothing's really jumping out on that calendar. And so it makes you nervous. You say, shoot, this could continue on for longer, because I don't have anything that I would circle and be like, I think that's where the sentiment might change here, and we start going the other way. The event that I was paying attention to has already happened. So again, I don't think it was anything necessarily specific that he said. He might have been mildly more celebratory about what they've accomplished so far than baseline expectations. But I don't think there was any major policy decisions that were made or presented yesterday.
Yeah, definitely. So, and I guess earnings is probably the key thing that people have kept talking about, and what are the earnings and how they're coming through. So, I guess that could be potentially a catalyst if they were to go negative, but I guess we haven't really seen that as bad as people potentially expected.
Yeah, and I mean, thus far we've gone through about not quite to 40%, like mid 30% S&P 500 earnings, and I would say things have been fine. They haven't been good. They haven't been atrocious. We're just bumbling along and fine. Tonight can obviously be interesting. You get an onslaught, almost like 15% of the S&P, I think, reports tonight. So things could change here in an hour. But yeah, no, I don't think earnings have either scared people or made them overly excited. But again, I think when most folks had pretty negative sentiment and pretty light positioning, you kind of almost need bad things to happen. Neutral might not stop the way things are moving.
Yeah, and as you're saying, it's not really people investing as much in individual stocks, actually the index in general.
Yeah, I mean, it's definitely a good mix. But yeah, I mean, when you need to play catch up, if you're potentially underperforming during a rally, the other way you can, other than just buying call options or something along those lines, you can buy riskier things. You can end up going down the risk curve and buying more risky companies and selling your less risky companies. Another way to increase overall exposure in your portfolio. So I think a little bit of that's been happening over the last week and a half. But again, I think today was a pretty significant change. As a volatility guy, like it was an extremely interesting move today.
So I guess from your perspective, what in terms of your, I guess, portfolios and how you're looking to manage them, what are the key indicators that you're currently analyzing? Is it really that volatility, or is there anything else that you're looking at that's interesting you in the markets?
Yeah, so the only thing that we really, run on behalf of our clients, and where we think we actually have, some edge is definitely volatility markets. Like that's where we're very focused. All that said, I am a born and bred fixed income guy. Even though most of my career has been in equity volatility from my day job, I've been mostly throughout my career at fixed income related shops, whether it was long short distress, whether it was a large fixed income asset manager. And maybe I was skewed by that, but I think fixed income markets drive most everything over the long term. Obviously anything can happen day to day, but I in general think that's kind of the most important asset class to pay attention to and how it relates to other asset classes. So one of my big themes, for my career, to be frank, but really big themes over the last couple of years was essentially interest rates. Interest rates are going to drive the bus. They're the discounting mechanism for practically everything. So after 10 years of low, stable interest rates, you kind of forgot about that important discounting mechanism because it didn't really move at all. Like if nothing's moving at all, you start kind of ignoring it as an important variable in terms of how to evaluate and value everything. And last year, that obviously changed. You had a significant change in interest rates, both in absolute movement, but also day-to-day movement. It was really high realized. And that was driving realized volatility and absolute movement in all asset classes. My gut for this year is that people have maybe become, for the first time in a long time, overly fixated on interest rates because of that near-term experience. Along with, I think interest rates are likely to be range bound, especially in comparison to anything like we experienced in 2022. As a blend of, we have central banks that are still fighting a battle and are going to maintain the stance that they have to some extent. So that's kind of putting a little bit of a floor in yields. It's going to be tough for yields to drop too far when their policy is going to be forcing a little bit of the opposite. And obviously we're a little bit worried about recession or close to recession, or at least slower growth than we've been experiencing. And that's probably going to put a little bit of a cap in yields. And so I think the year of 2023, after a very, very volatile and interest rate fixated year in 2022, is rates are going to be kind of boring and range bound. So if it's not interest rates, what is it? And my fixation for this year for sure is credit. Credit is incredibly interesting to me for this year, partially because we're walking into this year, and it's already tightened a lot, but at very, very tight levels in both investment grade and high yield. So you have the backdrop of a year with not fantastic returns in practically any asset class, along with this belief that growth is slowing with the potential for negative growth at some point this year. And yet credit's walking in saying nothing to see here. We're tighter than our kind of like 50th percentile. Like this is actually going to be a better year than other years in credit. And I think that's what is interesting to me. That's what I want to pay attention to, because I think that might be our leading indicator for kind of where we're going to go the rest of the year.
So what does tight credit mean? How does that sort of impact the markets? And then I guess, yeah, the credit market and just in general, the rest of the markets. Yep.
So there's two things that I think were really important about the credit markets. Like one is obviously we're a highly financialized society, not, US, globally, everybody. And so the ability to borrow is incredibly important for a lot of things, day-to-day operations, for investment strategies. A lot of them use leverage or some version of leverage. Like everybody at somewhere in their life is essentially utilizing credit in some aspect. Buying your house, we all use credit. And so when things become more expensive, it slows everybody down in terms of their ability to expend, their ability to invest, whether you're an individual or corporate, so on and so forth. So it's obviously important from like a day-to-day perspective there. The more, I would say unique to financial assets is credit tends to be the source of illiquidity. It's still an asset class that there's not a hyper liquid means of trading it. Like, yes, you can kind of push through large volumes of credit when things are good, but it also tends to be the asset class that seizes and freezes up when things are bad. And when that experience happens, that illiquidity in credit markets, it tends to not take very long to start showing up in other asset classes. So, the mixture of it's kind of how a lot of the world, both in terms of day-to-day life and financial assets, kind of operates as a backdrop, is that's the financing mechanism. Mixed with when you see any sort of bouts of illiquidity, it usually starts in credit and then expands into other asset classes. So, that's why I'm pretty focused on it here, especially considering the actual levels of where we are, where credit is pretty incredibly tight.
Yeah, it's really interesting. And in comparison, how have we seen it this tight recently?
So,
or before this?
Yeah. So, you've never seen it this type before. That said, though, investment grade credit on like the long end, so call it 10-year plus maturity investment grade credit in the US is like 20th percentile. So like really, 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 tighter than average. Not the tightest it's ever been, but like pretty darn tight. And a lot of that is coming from, I would say, structural flows, and not necessarily fundamental reasons. The main two fulcrums of that is both. You have excess demand and less supply. So that tends to drive prices higher, i.e. credit tighter. Where that demand really came from over the last 12-ish months is from US pensions for the most part. So US corporate pensions have become very, very well funded. Most people would say, well, what the heck? Wasn't 2022 a really bad year for all assets? And it was. The assets in these corporate pensions are absolutely down, but their liabilities are down even more. Their liabilities, all those cash flows that they have to pay out to retirees in all these future years, they're discounted back to today dollars. That's your current liability profile. And the answer is those liabilities went down a lot more than what their assets went down. So they actually are in a better position. Corporate pensions are well funded, frankly, for the first time since basically 2007. And the first time they're overfunded in that many years. And so what happens when those corporate pensions become incredibly well funded, they want to de-risk. They say, hey, we're done. We learned from the last 15 years of ill wills of being underfunded. It sucked up a lot of my time as CFO or whoever else was responsible for that at a corporate. They want to be operators. They want to keep making and selling widgets. And this overhang of a pension was not an entertaining subject matter for them for 15 years. They finally made it to the stance where they're potentially fully funded. They want to not worry about it. And what's the easiest thing for them to do to not worry about it is reduce a lot of your risk exposure, whether that's equities, PE, VC, and buy assets that look like your liabilities, which is essentially long dated investment grade credit. So this is not because they think credit's cheap. This is simply, I want to put my pension to sleep so I don't have to worry about it anymore. So sell the things that don't look like investment grade credit and buy investment grade credits. That was a pretty significant driver of demand over the last year. A little sneaky additional driver of demand is in a lot of the fiscal bills that have been passed over the last 2 years. There was embedded in them, there's always pork and every bill that gets passed, especially when they're $1 trillion as a headline number. But in those bills, they created pots to go ahead and give assets to union pension plans. And when you give money, if you're the government and you give money, you tend to have strings attached to that money. And one of those strings is, hey, we're going to go ahead and give you a little bit of additional money to make sure your pension plan is well funded. And all those folks are more likely to have a stable retirement. But you can't go take this money and go buy a bunch of high risk equities. You have to buy something low risk. And on that list of things is basically treasuries, investment grade credit, and a little bit of MBS. So anyway, 2 large drivers of demand for this investment grade credit. And then on the other side, supply. Essentially, credit supply in the corporate space has increased every single year since it became an established market. And it's grows at GDP plus, right? Companies grow, they borrow more money to go build more things, so on and so forth. So as the global economy grows, so does the amount of corporate credit outstanding. In 2022, total amount of US corporate credit actually was flat. It was one of the first years ever in like the 50 years of it being a real market where it was flat. So essentially the amount of debt maturing was the same amount as new issuance. And so the total amount outstanding was flat, which was not the expectations. The expectations were for it to increase at basically nominal GDP levels within a high inflation year. It means pretty big numbers. And my view, the reason why you didn't get supply to expand as expected is if you're a CFO over the last 10 years, you probably have been issuing debt to do things like share buybacks, increase dividends, some fun financial engineering simply because rates were so low. You're like, hey, if I'm an investment grade company and I can borrow 30-year paper at 3.5%, I like those odds of doing that and buying back my stock. Do I think my stock's going to appreciate more than 3.5% per annum over the next 30 years? I kind of like that as a bet. And a decent amount of CFOs have been doing that for the last 10 plus years. And the biggest companies like Apple went from almost zero debt outstanding to like 200 billion. Like in their world, they're 2 trillion companies, so it's nothing like outsized, but it's a lot of money. They issued a lot of debt to mostly buy back stock ultimately. When you're staring down interest rates at these levels, it's a harder decision. Like I can issue 30-year paper at 7%. Like, is that an easy decision to say, I'm going to pay 7% per annum to buy my stock back? Do I really think it's likely my stock outperforms that over 30 years? You probably still think it does, but it's not as easy of an answer. So supply in the last year and so far year to date has been well under expectations. And I believe that's probably the main driver. Why is the amount of quote unquote financial engineering, borrowing a bunch of money to buy back stock or issue dividends, has subsided, and people are only issuing debt to finance operations, which is a change from the last 10 years.
Yeah, it's really interesting. So does that just mean that I guess other investors who maybe can't get access to that move across, I guess, the risk curve to other assets, or do you see as that it could also be potentially that there's not much, there's not enough US collateral, because I guess a lot of people use US credit and US debt, fixed income as collateral for their US dollars. So do you see that sort of being the impact, or I guess what does this show for the rest of the market?
Yeah, so I mean, frankly, the only folks that really buy really long dated investment grade credit are pensions and insurance. Like it's a pretty unique investor profile. I mean, you and me buying a 30-year Apple bond is probably unlikely. Like that's not exactly, a targeted investment, nor is it, a heavy investment in most portfolios. Even though it's only really affecting those specific types of investors, it just trickles everywhere else because you're like, okay, if the long end is incredibly tight, should 5-year paper be wide? Like, no, it's gonna be tough. Like it becomes, a relative value opportunity for somebody to arb out. So even though it's a very large in terms of total assets, but a very specific segment of the credit curve, it's pulling everything everywhere else tighter, even though that's the main driver is this demand from, insurance and mostly pensions, along with lighter supply. These effects may or may not be, not ending, but they're probably slowing. The amount of corporate pensions that are already de-risked, i.e. sold equities to go ahead and buy this corporate credit, like they did a lot of it already. They don't do it again. Like we're already de-risked. Like there's nothing new to buy. It's a kind of a one-time event. So that's slowing. The amount of excess demand for those bonds is slowing. Supply still light, so that might not be instantly changing, but a lot of those dynamics that were very strong over the last 12 months are at a minimum slowing. So it'll be interesting to see, over the next handful of quarters, without that kind of technical march of tightening from excess demand from those folks, do things maybe stabilize to more, historically average levels rather than where they currently are.
So I guess potentially less volatility overall. Is that what you're saying, or just more for credit?
So I think right now it's been an incredibly stabilizing effect. Thus far, it has reduced the amount of market volatility. Simply, I mean, a lot of folks kind of draw the line between credit spreads and equity volatility without a doubt, because they tend to be very correlated. Now, to be clear, equity volatility can mean a lot of different things. You're like, I can buy a 1-day option. I can buy a 5-year option. I can buy an at-the-money option. I can buy a far out of the money option. And so the most similar thing in equity volatility space to credit is very, very long dated options and probably out of the money puts, because that's kind of what credit is like. It's like selling a lot of long dated, deep out of the money puts, because essentially you're receiving your coupon and you don't expect bad things to happen. But the best thing that can happen is you just get your coupon all those years and then you get your initial principal back. And, if you're an investment grade company, things got to get really, 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 really bad to the point where you're like, ooh, is my principal actually at risk? So the most similar thing to that in the equity space would be a, 5-year index level option that's 50% out of the money, something that's, again, in 5 years time, do I think equities will be 50% lower? Very unlikely. That's history says unlikely. So that's the most similar thing. But I definitely think that how tight credit has been and marching tighter has helped reduce implied volatilities in the equity market as well. Again, that's why I'm fixated on it, for that to change, because even if you just kind of normalize, if credit just goes from 20th percentile, 30th, 40th, 50th, you're like, this is just historical norms with a backdrop of possibly slowing global growth. That doesn't seem like an unreasonable march for things to take. That might have some destabilizing effects in equity vol markets and other things, even though ultimately it's just going back to kind of a normalized state rather than the current incredibly tight state that they're in.
Yeah, it's super interesting. So Zed, thank you so much for your time today. I've really appreciated our conversation. I don't think we've talked about fixed income, but I'm not sure if we've talked specifically about credit. So it's interesting to always be learning. So I guess my last question is, what is one message you'd like people to take away from our conversation?
I think the message you should take away is currently the market is not pricing in a significant amount of risk. Now, it doesn't necessarily mean anything bad is going to happen. Like there's no prognostication or anything along those lines. But currently, the market is truly pricing in a limited amount of future risk. And you have to make the decision, is your portfolio in a place where that's an acceptable stance to maintain? Like, are we going to be, A-okay? Or if we're in a place where you're like, I don't know how the next handful of years look. Maybe we're a little worse than average. Not saying the world's ending or a disaster, just maybe a little worse than average. You can possibly take this opportunity to adjust your portfolio to go ahead and be well positioned if things happen to change. It's always better to make those decisions when the market's giving you opportunity than any sort of seat where you might be forced to take the other side.
Yeah, definitely. That's a great message. So, Zed, thanks again for your time. Really appreciate it. So, if anyone wanted to find more about your work, I know you've done a few interviews. Is there anywhere else people could follow you in that regard?
Yeah, I mean, the best place to find anything that we're kind of babbling about is just convexitas.com. And then you'll see, myself and my business partner, Devin Anderson, a lot of stuff on LinkedIn. But yeah, we're a little old school. Website and LinkedIn. You're not finding us on Twitter or anything like that.
I know you don't have the Substack yet.
That's right. My computer screens are used for markets. Less on that side.
Yeah, no space for for that. All right,
That's
but
okay.
Zed, thanks again for your time. Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.